Hello, friends. I hope all of you are fine. Myself, Sambha Gupta. I am preparing this video just focusing on the fair value through OCI, the other comprehensive income. Because this is little bit like Miss, what I have seen that in the institute, in the material, they haven't covered in detail about from the computational aspect, like uh, how Miss FVOCI is accounted for. So just I've taken the three cases here. So one is a simple case here, simple case, and then the another one is the exchange rate, where is the your investment rate is done in the another currency. Then how the FX impact will be taken, because there the Ind AS 21 is also coming into the picture. And third thing of the impairment. So it will be a short video, so it will give you a understanding about the FVOCA, why it is little bit like from the computation point of view it is challenging. Yep. Okay. So example one. So this I've already prepared it. So just quickly we will read because to save the time. Otherwise, like to write it and then to explain. So then it will be taking time and the video will would have become lengthy. Okay. So example one, a bond is purchased for rupees 90,000 whose face value is 1 lakh. Okay. And the coupon rate is 7% and the life of the bond is 3 years. So here the business model test is to collect the cash flow plus held for sale here. So that's why this and here the your SPPI it is of the interest and the principal. So that's why this instrument will be classified, this bond will be classified under the FVOCA, fair value through other comprehensive income. Okay. Now the fair value, this is the fair value. The fair value at the end of the first year is rupees 85,000, and the bullet repayment of principal is happening at the end of the third year. So just for the simplicity, I've kept it. I haven't kept like for that it is making the payment, like it is receiving it is receiving uh, the installment means it is receiving the principal in the installment. Okay, bullet repayment is there. Yeah. Okay, so first step is to calculate the effective interest rate. um, so here your purchased price is 90,000, that is a fair value. Okay, at the inception, and the coupon is your 7,000. 7,000 how it is coming for each year, because it's a 3 years bond, so 1 lakh into 7% it is coming 7,000. Okay, 7,000 for the first year, second year, third year, and plus the principal you will be getting, and this X will be your effective interest rate. Yep. And I am just presuming that you know how to calculate the effective interest rate uh, from the AFM class, or yep. So so your effective interest rate it is coming 11.10. So this is also making sense because um your fair value it is less than the principal amount. So that means it will be less than the principal amount when when your discount rate should be more than your coupon rate, then only. So this is also making sense. So it will be 11.1. Yep. So at the inception, what entry you will be passing? So here just I haven't taken the transaction cost here for the simplicity. Otherwise, you can also take the transaction cost here. So the transaction cost would have been added here. Yep. Because here we are talking from the financial asset point of view. So investment in the bond 90,000 to cash 90,000. So this is at the inception. Okay. Um, okay. So 11.1 is your effective interest rate. It is coming. So at the inception, you will be passing the investment in bond to cash 90,000. Yeah. So here the small things are there. Otherwise, like if you don't do the computation, it's not difficult. But yeah, very subtle things are there. Uh, this you will appreciate uh, if you are doing the competition. Then only you will face this issue. Yeah, otherwise you will not uh, you will not find this problem. So like okay, so at the end of the first year, so this is the equation. Just keep this in mind, like because this is a very important thing, and here it will become little bit more and more small things will be coming in this. So 90,000 is your opening balance, yeah, opening balance, and then on this you will be calculating the interest, that is 11.10. You will be multiplying it with the 90,000, then it will be coming 99,990. So this is your interest on the basis of the effective interest rate. The amortization table which you prepare. So I have just prepared in the form of the equation here. So this I am just talking about the first year. Then okay, then your the coupon. So coupon it will be deducted. So coupon you will be receiving. So then after that, whatever the amount it is coming, 90,000 plus triple nine zero minus 7,000 equal to 92990. So this is your gross carrying amount. So normally in the amortized cost amortization table, you prepare till here only. Okay, so now here this is the thing. So like because this is the FVOCA, so from here you need to also take care of the fair value, whatever the fair value it is there. Because you must have read that in the fair value OCI, other fair value through OCI, so in that whatever the fair value movement is happening at the end of the each period that you're transferring it to the OCI. So which one? What is that value? So so that's why I prepared this example here. So here what I've mentioned here, the fair value at the end of the first year is rupees 85,000. Okay, so 85,000 is your fair value, or you can say it as a carrying amount. So 92,990 minus 7,990 is coming 85,000. So this I have taken as a balancing figure here. Okay, so back calculation. So 92,990 minus 85,000 is equal to 7,990. So this 7,990 is your fair value movement. Okay, and for this thing, what entry you will be passing? OCA account to bond account. So this is the thing. So like here, this is the amount which you will be transferring it to the OCA account. So this is a catch here. And similarly for the other, for the remaining for the interest accrual, what you will be passing the bond account to P&L or bond account to interest, and then interest to P&L. So, but here I've just taken directly into the P&L. Okay, and then for the coupon, receiving so cash account to bond account, this we have done. So this is the catch here. So this I was just trying to say, like otherwise if you haven't done practically, so then you will not appreciate it. So directly maybe you will face the question in the exam, so then without doing the practice, without if you are knowing about it, so you cannot solve it. Yeah, so that is an issue. So this is a thing. So this is the gross carrying amount, this is the gross carrying amount, and this is a fair value, or you can say as the carrying amount. Yeah, and in the balance sheet you will be showing this 85,000 as the asset in your balance sheet. Otherwise, if you would have done for the first time, like means if you haven't done, so directly what you will be doing, so 90,000 minus 85,000 you will be taking and you will be transferring it to the OCA, which is wrong. Okay, so that's why it is said as a mixed approach, FVOCI. So where you are y- following the amortized cost method also, and then you are blending it with the mark to market movement. That is your blending with the FVTPL impact. Okay. So this is a mixed approach. So that's why. So I hope this is clear. Okay. And the second thing, at the then for the at the end of the second year, you will be taking the opening balance. This one you will be taking, not this one. So so at the end of the second year, this one I am just writing here. Second year, you will be taking 92990, and then you will be doing the same calculation here. You will be calculating the interest here on the basis of the effective interest. rate. So 11.10 you will be applying it here, and then minus coupon, and then you will be coming at the closing balance, and then again whatever the fair value is there at the end of the second year, that you will be doing it, and then you will be taking the balancing figure, this one. Okay. So this is also another catch on which open uh, means the on which opening balance you will be calculating the interest on through the effective interest rate. So this is the one. So gross carrying amount you will be taking here. So this is also the another catch here. Okay, so small things, but yeah, you need to keep it in mind, because what I have seen that in the institute's material, they have focused more on the amortized cost. They haven't talked so much about the FVOCI. So maybe in the future, like they can ask the question on the FVOCI. So that's why you need to be ready for the FVOCI also. Okay. So this is the one thing. Now coming to the example two here. So this is the same example I have taken. So just I've changed uh, rupee into the dollar, and then I'm converting it into the rupee. Okay. So the foreign currency bond I have purchased in this one, in the second example, and my reporting currency is is rupee. Okay, the same example, the same amount, just I've changed the currency, and then I've taken the exchange rate here. So a bond is purchased for $90,000, whose face value is 1 lakh dollar. Okay, you must be also seeing that just I've overwrite, and coupon rate is 7%, so life of the bond is 3%. This is the same thing. Okay, now the here the exchange rate is at the inception is 90, and uh, at the end of the first year your uh, dollar is 100, and the average rate will be your 90 plus 100 divided by 2, that is the 95. Yeah. Okay, so now the same thing. So I am just focusing on that at the end of the first year. So here the exchange rate is also coming. So in the material, it is not written that for the FVOCI, if I am correct, that for the FVOCI, whatever the FX rate movement is there, so where it will be going? So it will be going in the P&L, profit and loss. Like similarly, the interest or the dividend, if it is there, so those are also going into the P&L. Yep. So for the dollar, so this I've written in the equation, like in the dollar, then the exchange rate, and then the rupee. The simple thing. So this I've just copied from the above. So 90,000 9,990. So this 9,990 is how it is coming. 90,000 is your opening balance. So 90,000 into 11.10. That is your effective interest rate. It is same here. So this effective interest rate you will be calculating uh, as it is, like means what I have done in the previous example. So there you have calculated on the dollar amount. So just keep it in mind. You haven't calculated in the rupee amount. So in the dollar amount you will be calculating, on the dollar amount you will be calculating the effective interest rate. Yeah. So 9,990 and then minus 7,000 equal to your this thing the same as it is. So if you see here also, this is the same thing here. Okay, so 90,000 this one, 9,990 this one, this one, this one, this one. Okay, then exchange rate I have taken 90 here, the opening. Then for the interest, you need to take the average and the coupon normally you pay at the end of the year. So that's why yeah, I have taken the closing rate. Okay, not the average rate. Okay, and this is your closing balance, means the closing, the gross carrying amount. So gross carrying amount. So on the gross carrying amount, you need to apply the closing rate here. Okay, and this is 7,990, which is your balancing figure, which I was telling you, 92,000 92,990 minus 85,000. It is coming the 7,990. Okay, so on that also you will be taking the closing balance, not the average rate. Okay. So just see the benefit, like me just I presented in the form of the equation, so then it's very easy. But yeah, if you are doing for the first time, then you are bound to do the wrong computation. So just I multiplied this one 90 into this one, so it is coming 81 lakh. Then this one uh, into 95, and this one into 100. Then this one is it is coming, and this one into 100. This is coming, so same as it is. Yep. And then So the entry will be same. So like because you need to pass it in the reporting currency and your reporting currency your INR. So then bond to panel for the accrual of the interest and then cash to bond whatever you're receiving. So 7 lakh you'll be receiving in INR. Okay. So see, and this is another catch here. So the FX impact normally if you are doing for the first time, so directly what you will be doing, so 81 lakh sorry, 92 lakh this amount minus 81 lakh you would have taken, but that is wrong. Okay, you will be taking this amount, so 83 lakh 49,050. So how it is coming? So this I have just encircled. So this 81 lakh plus this one minus this, it is coming 8349. Okay, and and here this one, so 92 lakh 99,000. How it is coming? This one into this one. Okay, so the difference of it, so this is the FX impact. So for this one, what you will be doing, so this is here the FX impact is beneficial because your dollar has strengthened. Okay, because your exposure it is in the dollars, and here your dollar is appreciating from 90 to 100. So this also you need to like when you will uh, doing more and more caution on the FX rate, so then you will start uh, saying in the manner the in the way in which I am telling you this, it is appreciated. Yep. So so this amount, this minus this is the bond to P&L. So this is the another entry. So this is see. So this is the FX impact here. It is coming. So that's why you need to do this thing. Okay. So this is your additional entry because of the FX here. And this one it is same as it is. So OCI to bond because your fair value has gone down. Okay, so this is the thing here. So here the catch point is that you need to multiply with the FX rate, and which FX rate you need to multiply, that you need to remember. So here you are taking the average rate, here you are taking the opening rate because the opening balance, and the coupon normally you are receiving at the end of the each year. So then you need to apply the closing rate here. Okay, and this is your gross carrying amount. So and on this you need to apply all the closing rate here. Yep. So this is the entry here. And again, for the third year, uh, sorry, not for the third year, for the second year, you will be taking this balance, okay, the dollar balance, and on that you will be applying this rate, the EIR rate. So same as it is, you will be doing it. So the catch point again, you will be taking this balance as an opening balance for the second year, not this balance. Okay, and and then the same, your the closing rate will become the opening rate. So 100 with the 100 you will be multiplying it, and then you will be doing the computation. Yep. So that is a repetitive one, but yeah. Okay. Now the last piece is your the impairment one. Yeah. So this is uh, unless because I am from the banking sector, so that's why I can say that how the practically it is calculation is happening in the impairment. Because I read the material of the CA Institute, it's not they haven't done the justification, but yeah, I can understand from their angle because unless until you know from the practical point of view, you will not appreciate about it and see the impairment if you want to make the career in the impairment side because impairment of the financial asset in the banking sector because that is also the another area dedicated teams are there for the impairment. Okay, so you should know how the calculation is happening there and all those stuffs. Yep. Okay, so again the same example here. So just I've done some tweaks there. So bond is purchased for 90,000. So this is the same thing. Whose face value is 1 lakh. Coupon rate is 7%. Life of the bond is 3 years. Business model test. So just I've added here because just I want to tell that okay, so this is the FVOCI instrument, yeah. And then fair value at the end of the first year is 85,000. Bullet repayment of the principal at the end of the third year. Yeah. Now, so this I have added here. for the impairment. If at the beginning, normally when you are purchasing it, so then from the inception you need to create the provision. Yeah. So when this was introduced, this concept, so there was like a lot of uh, argument were there how you can make the provision at the inception itself, because at the inception you are you're doing the transaction at the fair value, correct? So then how can you say that the fair value you will not recover? So there was a lot of argument, but then it got settled down. So, and the conclusion is like after that argument that yeah, so the ISB board they remain stringent about this thing, that from the inception you need to create the provision. That is a loss allowance, you need to do it. Okay. so so this is your and this loss allowance it is coming for the financial asset, not for the financial liability. Okay. And here, even if your this thing, you are doing the fair value, this FVOCI, but then also on that also you need to have the loss allowance. This I will tell you why. So then you will appreciate it. Okay. So there this concept is there 12-month ECL and the lifetime ECL. So 12-month ECL means so this bond's life is 3 years, correct? So just I've made the picture here. So this is the first year, second year, third year. Just don't focus on the amount that I will explain you. So what? So 12-month ECL means what? During this first year, whatever your default event is, like suppose your default event is that the credit rating is going down. Like currently at the inception, your credit rating is triple A plus. Okay, triple A plus your external rating, and your default it will uh, the credit risk deterioration it is talking about. Yeah, credit risk deterioration. So, but here I am taking the default rating here. So, like, what is the chance? What is the chance that by the end of the first year, the issuer, your bonds rating goes down from triple A plus to D. Okay, so this is your default event I'm saying. So you need to also define what is your default event. Yeah. So this is the one default event I have taken, that triple A plus to D. So this is a default event. So what is the probability that in the 1 year that your rating that the bonds rating will go down from the triple A plus to D. Okay. So that is the interpretation of the 12-month ECL. So this is the probability of default. What is the chances? So what is the chances? So here I have taken the 12-month ECL. So 1% it is. So 1% chance is that the rating of that bond it will it can go from triple A plus to D or below in 1 year time period, and that is a 1% chance it is. Yeah, so this is very important how you are interpreting it. Yeah, you should know about it. Okay, and if it is a lifetime ECL is there, so then so instead of the 1 year, then it will be your lifetime. So here my lifetime of this product is a 3 years. So then it will be this one. Okay, this one. So what will be the probability of uh, 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 what is the chance? Probability means what is the chance that my this bonds rating will go down from the triple A plus to triple to D in the 3 year time period. So that is the interpretation of your lifetime ECL. Okay. So normally in the beginning, so it is like unless it is a credit impaired product. So normally, and if it is originated, so then it's like you're taking a 12-month ECL, yeah, because uh, hardly that the credit risk will be higher at that time, yeah. So at the inception, so normally it is a 12-month ECL it will be taken. So 1%. So now just see the computation also normally, because the institute they haven't focused so much in detail here, but yeah, just for the knowledge purpose also, maybe in the future, like the institute they start asking once they know about the practical exposure about this thing. So simply in the question for the loss allowance, uh, that is your provision. What is the formula? The probability of default into loss given default into EAD. EAD means exposure at default, means at the time of the default what will be your exposure, okay, and the whatever the exposure is there, so uh, how much means how much, because normally the default if it happens, then something you are able to recover it, yeah. So like suppose if your exposure is 100, then how much you are not able to recover, so that is your LGD. So say means 40%, so that means out of this 100, I will not able to recover 40, 40% of it. So that means on the default I can recover 60%. So that means I can recover from like selling of that issuer's asset, from there I can recover rupees 60. Yeah, because here it's I have taken 100 here. Okay. And the PD, what is the chance of this default happening of it? Yeah. So this is the PD here. So 1% here. So now coming to the solution here. So at the inception, uh, so here the coupon is your 7,000. So see, so this is the catch point here. So how it is done? Because it is mentioned in this material that the you need to take the PV. So how you need to take the PV? So this is what I am telling you. So this is the actual thing. So it's very difficult to visualize, but yeah. Now if you understand this example, so then you can visualize it also. So on the interest also you will be applying this 1% and in this one. So 7,000 is your exposure, 40% is your loss given default, and okay, and 1% is your probability of default. That the chance that that the event will occur in the next 12 months. So when that event will occur, then you need to calculate it for the 3 year, for the whole year. So this is the catch point here. So 7,000 into 40% into 1%, it is coming 28. So this 28, see the PD you have taken in the 12 month you have taken for the first year, but you are doing the calculation for the lifetime here. Okay. So this is like unless you know practically, you will not appreciate it. So whatever the PD you have determined, the percentage, you need to apply it for the lifetime. Yep. So this 28, this is your coupon. 28, this is your coupon. 28, this is your coupon, and the 400 is your principal amount. So this you will not able to recover. Okay, and this you need to discount it today itself because you are standing here at the inception. And this you will be discounting at the same effective interest rate, that is 11.1%. So it is coming 360. So, and this is your FVOCA product. So then you will be uh, passing the entry P&L account to OCA. That is a 360 here. Yep. And at the inception, what you will be passing for purchasing a bond account to cash. That is your fair value or your transaction price. So 90,000. This one. Coming to the end of the first year. So this I will explain you. Uh, this entry, then you will appreciate, because at the inception you will not appreciate it. Yeah, but at the end of the first year, then you will appreciate. So this I will explain you. Just hold this thing. So if you see the interpretation of this entries, that from the OCA you are transferring it to the PLL. So in the loss allowance, normally like if you are from the debtor point of view, so how you pass the entry PNL to provision you're doing it, correct? Provision for bad debts. And when this bad debt accrues, like means if it becomes actual, so then what you will do, you will be provision for bad debts to debtor you are doing it. Yeah. So at the time of creating the provision, you are not touching the debtors here. P&L to provision for bad debt. But when debt debtor is impaired actually, okay, actually, then you are reducing the debtors balance. but at the time of creating the provisions, you are not touching the debtor's balance. Yep. This try to understand this thing. So in the impairment, you are having a first stage, second stage, third stage. Okay, so I'm not going in detail here. So in the first stage and the second stage, you are creating the provision. Okay, and in the third year, you are in the in the third stage, that instrument is actually becoming impaired. So when it is becoming actually impaired, so then you are this you are reducing your the instrument balance, the means the financial asset balance. So this thing. So this is it is coming in the third stage, this entry, and this provision for P&L to provision for bad debt, which we know from our childhood, like okay, from the 11th and 12th, how to create the provision. So this is for the first stage and the second stage. Okay, so these are very small things. So that's what I was saying, that this impairment, it's like your another uh, like it's your career, like means you can make the career in this. So all small things are there. Unless you know practically, you can't appreciate it. Yep. So for the first stage and second stage, you will be passing this entry. So but here it's a FVOCI product, so that's why instead of provision here, passing you are taking it from the OCI, this thing. That's it. Yep. So like if it is a amortized cost product, means the amortized, if you have classified this instrument as amortized cost, so then here you would have taken the provision, not the OCA. So OCA will come into the picture for the FVOCA products only. For the amortized cost product, you would have taken here the provision for bad debt. So here the another name of that, the another name which is given by the accounting standard, the loss allowance. Loss allowance. So that is your provision here. So that is another name of the provision for bad debt here. Yep. And then when it is actually impaired, that means you're coming into the third stage. So then this loss allowance you will be debiting and you will be crediting, you will be reducing the debt bonds value, which is classified at the amortized cost. Yeah. So just see here. So in the at the end of the second year, at the end of the first report entry, you will be passing. So here now the at the end when you will be reaching here, so your PD is increased, but it's not significant here because significant it's saving the institute they have given the example. Yep. So normally for the significant increase, so there is very simple thing is a 30 days past due. 30 days past due. Uh, I think this one, then, if I'm not wrong, 60 or 90 days past due are taken, the DPD. So days past due. That means whatever your accrual means, the accrual date, not the accrual date, the date on which you should receive the coupon. Okay, if you are not receiving on that date, then from that date add 30 days. Like means if it is outstanding for further 30 days, so then it becomes past due. 30 days past due. Yep. Okay. Now calculating the loss allowance means you are the provision for the at the end of the first year. Now you are standing here. See this one. Now you are standing here. Earlier you were standing here. Now the 1 year is over. So now you are standing here. Okay. So this PD is 3%. Same. Just have simply increased the PD by 3% and LGD have taken it as it is. So this is not a significant increase. So this I have presumed. So here it's not a significant increase. So that means you will be calculating the PD, means you will be finding the default event, the happening of the default event in the next 1 year. Okay, in the next 1 year here, 12-month ECL I have taken. So here, so 12-month ECL, so 12-month ACL I have taken here. So that means the chances of probability of happening of the default event in the next 1 year. That is the meaning of the 12-month ECL. And if it is a lifetime, then chances of happening of that default event in the 2 years, because here the 2 years are remaining only. So that is your lifetime then. So it's the 3% here. So again the same thing on the interest you will be applying it, and then the on the principal you will be applying it. So your interest is 7,000, 1 lakh it is. 40% is your LGD and the 3% it is your um 3% is your PD. So it is coming 84 and this is coming your 1200. This is your 1200 here. So now present it in the number line because you need to calculate the present value. So 84 this one your coupon, and 84 you will be receiving, you will not be receiving it. This is your prediction, and the 1200 also the principal amount you will not be receiving. So then you will be calculating the PV of it, and the effective interest rate here is your same 11.1. That is your original effective interest rate. Yeah, so it is coming 1116. Just see the benefit of the equation here. So this is the same here. Okay, same it is as it is. This one. Uh, with your first example. So 90,000 is your opening balance. Then you will be calculating the interest by applying the effective interest rate. Then the cash you will be receiving. Okay, and this is your gross carrying amount. And then this is your balancing figure 92,090 minus 85,000. So this is coming 7990. So there is a reduction in your balance. So the mark to market reduction. So OCI to bond you will be doing it. So here you are doing the OCI to bond. So now, but here you're not taking this because this is unrealized loss. So that's why you're debiting the OCA. So out of this unrealized loss, how much you will be transferring it to the P&L? So this is the way to interpret it. So how much you will be transferring it to the P&L, because so how much you will be transferring to the P&L? So P&L to OCA, this is for the loss allowance. So this is what it is, because you are having a reduction in your fair value, correct? Fair value of this much. And out of this, how much you are saying this reduction, it's because of your this one impairment. Yeah. So from the impairment. So that means how much, see in this, it can be your interest rate impact is also there. Okay. And similarly here also the credit risk impact is also there. Okay. So interest rate risk is your market risk. Market risk. So whatever the reduction is there because of the market risk, so that you are keeping it in the OCI. But whatever the reduction is there because of the credit risk, so that you need to charge it to the P&L. So that's what. So whatever the amount, it's there is a reduction due to the credit risk deterioration, that you need to charge it to the P&L. So you are transferring from OCI to P&L. Okay, so that thing. So from the P&L you are charging it, whatever the reduction it is there from the credit risk. So this is 7990. It is a total reduction. It's because of the interest rate and because of the credit risk, and whatever it is relating to the credit risk that you are charging to the P&L. So that's why you are passing the entry P&L to OCI. P&L to OCI, this thing. And how much it is? 756. And this how much, how it is coming? Since 1116 is your this amount. Okay. And 360 is your what you have already taken at the inception. So 360. So this this minus this, it is coming 756. So this is the thing. Yep. Okay, just quickly I will be just giving you uh, uh, the thought that again, uh, for the second year you will be taking this balance. Okay, because it is in the stage 1. Okay, and similarly if it is in the stage 2 also, then also you'll be taking this balance. Yeah. If at the end of the second year, directly from the first stage, if you are going into the third stage, that means it is credit impaired actually. Yeah, credit impaired actually. Then you would be taking this, you will not be taking this amount, you will be taking 92990 minus your 1116. Whatever the balance it is coming, that you will be taking. Why? Because this is what the accounting rule it is saying, that the net, that means it is saying that for the stage 1 and the stage 2 you will be taking the gross carrying amount, but uh, for this thing, for the stage 3 you will be taking the amortized cost, or you can say the net carrying amount that you will be taking, and the net carrying amount your amortized cost is this one. Yeah, so this you will be taking. Okay, if you find this uh, video informative, because I know, because I took some time here to explain you, because for the impairment it's it's little bit complicated, and you will not be getting such type of detailed information unless you have practically worked in it. Yep. If you like this video, please subscribe it and please circulate among your friends. Thank